I definitely want to introduce our first speaker. He goes by the name of Dr. Barry Burns, and he's a businessman who has owned several small companies. His business background taught him to focus on the bottom line, so his study on the financial markets was for one purpose only, to make profits. He started his study on the markets under the direction of his father, Patrick F. Burns, who became independently wealthy through trading and had over 70 years of trading experience. Barry Burns furthered his education by reading over 100 books on trading and investing, and spent over $50,000 in trading courses and education. In addition, he hired 3 professional traders to mentor him personally. He even flew to Chicago to work with a former floor trader at the Chicago Mercantile Exchange. All of his research and study resulted in insights which eventually led to the development of his own methodology. A few of his accomplishments include he was featured in a case study in the book Using Candlestick Charting on how to earn high rates of return safely. He's the headlining speaker at Day Traders USA. He's given seminars around the country at many wealth expos and trading expos. He's currently one of the featured experts at Trader Kingdom as well. So I just want to go ahead, without further ado, introduce our first speaker, Mr. Dr. Barry Burns.
Okay, let's try that again. I was just talking there and realized that my mic I turned it on and then it turned back off again. So let's just double check here. For me, it looks like you can see my screen and you can hear me. But let me double check before we move on any further and make sure that everything is working well here. Can everybody see my screen and hear me? Everything's good. Okay. Yay. All right. Well, thank you so much to Joshua and Joseph and all the people over at Investor Inspiration for hosting this event. What a great event. You know, back in the days of yore, I'm 55 now, and my dad started me trading when he was 8, or when I was 8. My dad was a stock trader, and that was his passion and avocation in life. So I've been around the trading world for 47 years, and so I've seen a lot of changes, and it's just great that an organization like this can put together an event with some major traders, speakers, educators, and we can all sit at home and not have to travel halfway across the country and pay for airfare and hotel bills and all of that. Oh my gosh. Good job, guys. I just really want to take my hat off to you and thank you for hosting this event today. So let's jump right into it. And, well, you've already got a little introduction to me, so I'm going to skip that slide. And we're going to go straight to the good stuff, the legal stuff. Now, I joke about that a little bit, but actually this is very serious. And the legal things that are listed here, these regulatory statements, are not just for legal reasons, although they are for that too. But really, this is where your education begins. And this is very, very important. That's why I put the word important before disclaimer. Because when you come into trading, and even for those of us who've been around it for a long time, it's easy to forget some of these critical things. So I do want to start here and understand we're not just covering our butt by doing this, but we're also educating you. This is part of your education and really where your education begins. Because unfortunately, there is a lot of hype on the internet and with a lot of marketing of trading products. So the good news is we've got good people. They're very selective on who they choose to come to this event. So you're going to hear good stuff today, but you're still bombarded, I'm sure, with all kinds of stuff online and in your emails that just make it sound too good to be true. And if, like they say, if it sounds too good to be true, it probably is. So please understand that trading is very, very risky. Most people lose money trading. Some markets are leveraged. So talk to your broker, find out what your maximum risk exposure is based on the markets you trade, the margin made available to you, etc. They can tell you that specifically with regard to your account. You need to know your maximum risk exposure. Also, because the markets are so risky, only use discretionary money. That means please don't learn to trade with money that you need for your retirement, or for your kids' college education, or to put a roof over your head or food on your table. Information in this presentation is for educational purposes only. I'm not going to give any specific buy or sell investment advice. The information in this presentation is, of course, entirely at your own risk and for general purposes only, and we assume no responsibility or liability for errors or omissions. So bottom line, trading is not get rich quick. Trading is a profession. It is legitimate. Yes, it is. There's a lot of people who make a lot of money, but they're professional traders. And so if you want to be a professional trader, you need to treat this like a profession, just like we do. So that means getting a good education. That means putting in the time, the effort, getting the experience, and not falling for the shortcuts. All right? So having said that, let's jump right into it. Today we're talking about timing. I'm talking about timing. We're talking about the future of the markets. And the future of the markets, I'm going to give you an overview today. Some might get into some more specifics, but I'm going to talk about different types of cycles that occur in the markets. And this is just going to be a general overview, but a very important one, because timing is something that I find that a lot of traders overlook. Most of the time when I look at students' charts, what I see on their charts are things that have to do with price, but very little to do with time. But when you think about it, what is trading really all about? There's no certainties in trading. There's a famous saying that the market can do anything at any time, and that is true. So there's never any certainties. What we're always dealing with are probabilities. And we want to put the odds on our side, so over a large sample of data we will come out ahead. But in order to do that, timing is a very critical aspect. And when you look at a chart, and I'm a chart trader, I'm a technical analyst, and so when you look at a chart, there's really only two dimensions. There's the time axis on the bottom and the price axis on the right-hand side. So there's only two dimensions, but if you're not using some sort of excellent timing indicator, then you are missing out on fully 50% of the information on the chart. So think about that. How can you trade, meaning how can you establish a probability scenario when you're only using 50% of the information on the chart? Well, you can't. You can't. And one of my friends and mentors, I spent some time in Chicago. I got an apartment out there. I worked with a floor trader at the CME, and he was one of my mentors. Just an amazing experience. And he used to talk to me about this. And when I talk to amateur traders, something I hear a lot is they say, well, you know, I got in, I bought, then I got stopped out. The market went down right after I bought. Then immediately after I got stopped out, boom, the market turns right around and goes back in the original direction of my trade. And my friend in Chicago, my mentor, that's what he was talking about when he said, retailers are often right, but at the wrong time. So you might get a feel for trend, but when do you enter that trend? We want to enter at the right time so we don't get stopped out or expose ourselves to too much risk. And even though time is 50% of the information on the chart, the famous trader W.D. Gann actually said of the two dimensions, time is more important than price. So if you agree with him, then by eliminating time from your equation and factoring it into your trading methodology, you're actually dealing with less than 50% of the important information on a chart. So today we're talking about timing, and I'm going to talk about various types of cycles. And that's what timing is all about. It's about monitoring the different cycles in the market. So here are some of the cycles. This certainly is not representative of all of them, but these are the ones we'll cover today. Number one, seasonal or calendar cycles, very well-known cycle. Number two, volatility cycles, very important. When we talk about this, I'm going to share with you some insights on how amateur traders or retailers get it exactly wrong. Here's one that isn't talked about very often, order chaos cycles. That one you don't hear about very often. I'm going to share that with you today, and you better know about that or you will be in trouble. This is where overtraders get into trouble. Another one, coupling and uncoupling cycles. And then finally, the one that is the most well-known, which is the up-down cycles, basically the sine wave type patterns that markets make as they move up or down. Markets don't move straight up or straight down, they kind of wiggle up and wiggle down. And we'll talk a little bit about that too. That's the most well-known type of cycle. All right, so those are the 5 types of cycles we're going to cover here in the next 30 minutes. So let's begin with the seasonal or calendar cycles. There's various types. Agricultural market is probably the most well-known, and where a lot of this started. And very simple, in the spring, if you live in the northern hemisphere anyway, in the spring we sow, and in the fall we reap the harvests. And so this type of cycle is very well known. It's just part of Mother Nature, and agricultural communities and farmers have always dealt with the cycle. It's just built right into our experience of this planet. So, you might think, well, I'll, buy in the summer or the spring and sell in the fall. But of course, it's not that simple, because over the summer, disastrous things can happen. And I used to live in Florida. I live in Los Angeles now, but when I lived in Florida, one of the big things that was talked about every year was whether the orange crop would survive if they had a frost. And it would be disastrous to the orange juice industry if there was a frost and it was severe enough to kill off the orange trees. So if you were just to buy in the spring, sell in the fall, you would lose a lot of money if a calamity like that occurred, which it did periodically. And so one thing that a lot of farmers did was, this is really where the development of the futures market came from, was to hedge their investment in their agriculture, in their farming business. And so they would accept a price in the spring, and people would buy, and they would, maybe not get the best price they would if they held, but it was a part of an insurance policy against calamities. And then the people who would buy would, they'd get a good price, but they'd be kind of providing the insurance, and they would assume the risk, so that when the crop was actually available in the futures, then they would make money because they'd be able to then sell for more than they bought. And so that's one of the most obvious and well-known examples. The retail sector is another very, very well-known example. In the West especially, around the December holidays, is for a lot of retail companies the most prosperous time of the entire year. In fact, there's even some companies that make all their profits just during that holiday season, and the rest of the time is just basically staying in business. So that's one of the most common retail sectors. And so around that time, and they talk about it early, markets are always discounting everything. According to Dow theory, discounting means to basically be planning ahead. It goes along with the saying of buy the rumor, sell the news. So people don't wait, traders don't wait, investors don't wait to see how good the retail season was. They're actually anticipating it. They're placing their investments ahead of time in anticipation. And so they'd be looking around September, October, and trying to predict how well of a retail season there's going to be. Another one is the travel calendar cycles, and this comes around obviously summertime when people do a lot of traveling, but also holiday time. And so again, December and spring when kids go to spring break and things like this. So if you're investing in any type of travel companies, then you will see a burst around those times, hopefully. Now, if the economy is bad, then people may not spend as much time or as much money on travel. So that's one of the things I wanted to say right here, is that these are kind of the general rules, but they're not always consistent. They're not always consistent. Trading's not as easy as that. Oh, no. No, I wish it was. That would be great. But, of course, if it was that easy, then everybody would be doing it. And by the time everybody does anything, it stops working. So that's why it's important to become a chart reader, to be able to read the charts and not just read a calendar, because you have to look at these things to say, okay, here's sort of the meta pattern that I'm looking around this time of year, but now let's look at a chart and let's see what's really happening here. Are these retail markets, companies starting to really crank up? Are the travel companies really starting to crank up? What's happening to commodities? Are they really starting to, go, or are they starting to move down? So it's important because a chart tells the truth at the moment in real time. To me, it's similar to the saying of actions speak louder than words. A chart shows you where people are putting their money. People put their money where their mouth is. I don't care what the pundits are saying on TV. I don't care what the newsletters say. That's all talk, and talk is cheap. What I want to know is, where are people actually committing their money? That's what the chart shows you. And that's why I like trading charts. Now, this is just one energy, by the way. My trading methodology is called the 5 energy trading methodology. And timing is just one of the 5 energies I use for trading. So again, I just want to put in the caveat here that as important as timing is and as important as cycles are, they're not the end-all be-all. They're not the whole. There is no one holy grail. A trading methodology is something that incorporates numerous variables, and when you put those variables together and you consider them as a whole, that's what establishes a probability scenario for you. Cycles, timing is 20% of my overall methodology. So here's another calendar cycle. Some people call it the Halloween indicator. Basically, it's the thing where you buy in the fall, and in May you go away. We're all familiar with that, I think. We've all heard that. It's a very common and well-known one. So again, just to illustrate the point that things are not always that simple, and that you can't just can't trade a calendar. Here's an example from a few years ago. Would have bought in November of 2007, and then you closed out your position in May of 2008, you would have lost money that cycle, that Halloween cycle, we'll call it. Then, if you would have stayed out until November, well, actually, then you did good because the market continued to go down. Now, if you bought back in November, actually, you'd be somewhere up around here, and then you closed in May, you probably would have about broken even, maybe lost a little money. Unfortunately, if you went away in May and then you put your money somewhere else in bonds or some interest-bearing account or something, and then you decided to put your money back into the stock market in November, well, then you had an opportunity lost because the market actually moved up quite nicely during that time. So just an example of how these are general rules. But then you take the general rule and you look for yourself, and you learn to read a chart, and this way you can actually find the exceptions. And sometimes the exceptions to the rule provide the best opportunities because most people are being fooled. Provides a great opportunity for you. Often offers favorable pricing. Okay, the next type of cycle is the volatility cycle. I love this cycle. This is a very, very powerful one. One type of trade that I use on this is called the ex-con trade, and that stands for expansion contraction. And that's what happens. The markets don't, it's not, the cycles we think of as like sine wave patterns, up, down, up, down, up, down. And that's true. But there's another type of cycle here with volatility. Volatility has to do with the range of the market. How wide a range is it making, or is it just a very narrow range market that's not really moving very much? The range of the market, it determines your ability or even the possibility of how much money can be made. If you're, other than selling options and things like that, if you're actually trading the market, buying or selling or shorting, then your profits are limited by the range of how far the market moves up or down. So if we're in an expansion cycle, that means volatility is increasing, and the market's making a wide price range, covering a wide range of price in a short period of time. During contraction cycles, the market is in a narrow price range, and therefore the opportunity to make a lot of money just simply isn't there because the market isn't moving. Now, here's the problem. Most people are familiar with this idea in general. And so people are looking for high volatility markets to trade. And so what they'll do is they'll do this exactly wrong. In fact, it's amazing how retailers are so skilled, I mean super hyper skilled at doing everything exactly and perfectly wrong. And people will even tell me that's like, oh my gosh, the market knows what I'm doing. I've had people even say, they'll have a $5,000 account and they're accusing their broker of targeting them and trading against them as an individual. And I'm like, I just am not really sure that your broker is that interested in your little $5,000 account and trading against you. But I think maybe if you get a better education, maybe that's the problem. You need to get educated more. So this is one of the things where I see people trading exactly wrong. So they will scan for high volatility markets because they want to be in a market that's making big moves. And that has a sort of logic to it. The problem is this, is that when you scan for a high volatility market to trade, by the time there's enough data for that high volatility market to be calculated and show up on the scan, you may be getting in right at the end of the high volatility cycle. Now, these cycles expand and contract and can last various periods of time. But it's not unusual for people to find these high volatility markets right about the time that that high volatility cycle is about to end. And contraction is going to set in, and the market will go into a low volatility cycle. So they think they're getting into a high volatility market, which I guess they are in real time, but the problem is we're more concerned about what's the market going to do after we get in. And so scanning for high volatility markets is often a really bad idea. So what I do is I do the opposite, of course. I scan for low volatility markets, and then I pull up a chart. That's not enough. Scanning for low volatility is not enough. Again, you have to look at a chart, be able to read a chart, and see what you have. You might have a simple very narrow range channel going on. You may have a triangle. You may have a wedge. It could be ascending triangle, descending triangle, symmetrical triangle. And learning how to trade these things is good. And then you can look at it and you can see, okay, how far into this low volatility cycle are we? How many times have we hit the upper trend line, the lower trend line? And then we use multiple time frames in order to determine the direction to trade. This is one of the big questions I often get out of these types of contraction patterns, is how do I determine which way to trade the breakout? And the simple answer to that is I use the next higher time frame to determine the direction. So don't have time to get into all of that now, but what I like to do here, there's basically three ways to trade these contraction patterns. One is to draw your trend lines on the upper and lower levels of the contraction area, and then trade the breakout. And that's very common. A lot of people like to do that. I don't do that. That just doesn't sit right with my psychology, but I have friends who do it and who do it successfully, so it is a valuable approach. Another one is to wait for the breakout and then the throwback. When you have a contraction pattern and then the market retraces after the breakout, it's not actually called a retrace. The proper terminology for that is a throwback. And that's a good way to do it too, but the problem with that is the market doesn't always come back to the trend line. Doesn't know it. Sometimes it just breaks out and takes off and you don't get the opportunity. So not a huge problem. It's just that you will have some opportunities you're not able to catch. What I like to do is I personally get a little more aggressive on it. I like to trade inside contraction before the breakout. So if I believe if we're in a triangle, for example, and I believe the market's going to go up and break to the upside, I will buy off of the supports of the lower trend line inside of the triangle. So a little more assertive approach, but the risk-reward ratio is better. And even if it doesn't break out with my money management, risk management, I normally don't lose any money on the trades. So I'll just get like a break-even trade and get to try again. So again, these are things like triangles, Bollinger Band squeezes, wedges, etc. And even intraday, I'm a day trader as well as a swing trader and investor. I trade all 3 time horizons. But there's a meta pattern for day traders, which is this. Generally, in the morning, we'll have a high volatility cycle. In the midday, we'll have a low volatility cycle. And then in the afternoon, we have a high volatility cycle again. Again, this is a meta pattern. It doesn't happen all the time, but this is a general rule. Now, one of my favorite trades when I'm day trading is to trade right at the end of lunchtime, because again, I'm trading at the end of that contraction cycle and getting in on a new expansion cycle, therefore getting a great reward to risk ratio. What I've noticed, though, again, being a chart reader is very important, and even being in Chicago and being on the floor, I've been able to watch it. That's the big advantage of being at the exchange is, with screen traders, we start to think that, moving averages and stochastics and MACD and RSI and CCI and all this stuff actually is how the market works. No, it's not. Those are indicators, and indicators do what they promise. They indicate, they don't tell. So that's not really what the market is. The market is people. It's people. It's an auction place. And the advantage that the people at the exchange have is they can look around and see the people. They can see, is everybody here? Is everybody on the floor? Or have people left? Is it a light day today where a lot of people didn't come in because they say, nothing's going to happen today? Or people leave early for lunch, or do people come back early from lunch, or do they stay through the lunch hour? Who's bringing orders in? Of course, the big funds and corporations, they try to hide that, but you can still get some ideas, get some hints. You can talk to people, and it might just be rumors, but sometimes the market moves on rumors too. But those are all very important things to see. But anyway, one of my favorite trades, like I say, is I'll watch the market, I watch the volume, and you can even subscribe to services, swap box services, where you can start to get a feel of what's going on the floor if you want to do that. But anyway, be careful because this meta pattern is not always true. In other words, people will go to lunch early, or they'll come back early specifically because they want to get an early jump on the retailers. So you can do that too once you know that. Now, here is one of the most interesting cycles that I never hear anything about from other people, the order chaos cycle. And this one is huge, really, really, really important. So there's 2 extreme schools of thought about this. One is that the market is a random walk, and you've probably heard of the book Random Walk Down Wall Street, basically saying that you can't establish a probability scenario as a trader, and the market's just a random walk. The other side is the other extreme. These are 2 extremes, is that the market is perfectly orderly and predictable, and here are the people who will say they've been able to predict the market 20, 30 years out to the exact time and price. So 2 very different opposing viewpoints. I've read a lot of both of these, and each time I've read each of these schools and their documentations, their studies, their examples, very convincing, very convincing. They both make a good case. They really do. And they can both validate with examples their point of view. So it became confusing to me because I thought, wow, here's these two different ideas, but they both have merit. And then I realized, again, as I started looking at the charts myself historically, what I realized was that they both do have merit. They both are right, but at different times. And anytime you hear the word time, think cycle. So what I realized was there is a cycle between times when the market is very orderly, and those are the times when we can establish a probability scenario. And then other times the market will go into just kind of a chaos, unpredictable pattern. And that's when we cannot establish a probability scenario. Generally, what's happening is during the orderly times, you got professional money coming in, and they will continue adding to their position. They have an agenda, and that's what creates a nice sine wave type trend. The chaotic time is usually when it's left to the little traders trading their 100 shares or their one contracts, things like that. And it reflects the psychology of the retail trader, which is very schizophrenic, very fearful, indecisive, getting in, getting out, small volume, and that sort of thing. So this is why overtrading is the cardinal sin. Because with overtrading, people are just trading all the time. And so they're trading through both orderly times and chaotic times. So if you've ever had the experience where you were making money for a little while and then you gave it all back or more, it may very well be that you don't know the difference between an order cycle and a chaos cycle, and you're trading through both. So you're making money during the orderly cycle when the market makes sense, and then you're giving all your money back during the chaos cycle. So this is the foundation of my methodology, where I trade the 5 energies. When the 5 energies align, all saying buy or all saying sell, that is how I define an orderly market. And each one of these 5 energies is uncorrelated to the other 4, which is exactly what makes it significant when all 5 energies align. When the different energies are saying up, down, up, down, that's chaos. That's chaos. The next cycle is the coupling and uncoupling cycle. Very well-known cycle. I remember when I first started trading, people said, well, stocks and bonds trade inversely to each other. Sometimes they do, but again, as I watch the market, I realize that's not always true either. So what we do is we watch sectors, industries, countries, currencies, commodities, interest rates, and you'll see that sometimes they couple, meaning that they'll be trading in the same direction, and then other times they will uncouple, where they will start trading in opposite directions. These provide opportunities. When what I actually normally am doing is I'm looking for the uncoupling. I watch for markets that are trading together, and then I look for them to start to diverge, and that divergence creates an opportunity. Again, I like to get in as early as possible on that divergence. I'm always looking to get in as early as possible on everything I do, whether it's trend trading or a new momentum or whatever. So what we do here is we use a relative strength approach. And it's very, very difficult to outperform the S&P 500, which is normally used as the benchmark for funds. But if you're going to try to do that, then one way to do that is to use this method where you use relative strength. And so you use the S&P 500 as your benchmark, and then you use a relative strength technique, which is not the RSI indicator, by the way, in order to find markets that are starting to outperform the S&P 500. Or you can use any benchmark that you want. I use the S&P 500 personally. And get in as early as possible to that market. You're looking for the uncoupling. And finally, the last cycle of the up-down cycle. This, again, is just the issue where markets go up or down, but they don't go straight up and they don't go straight down. They wiggle up and they wiggle down. And, you know, markets reflect human nature because it's people that trade the markets. And, yeah, even though in the stock market over 50% of trading now is done with computers, the computers are still programmed by people. They're still programmed based on people's beliefs and feelings and philosophies of the market. They're still overseen by human beings. They're still watched by people, even those computer programs are monitored very closely by human beings. And so the markets actually reflect mass human psychology, not individual psychology, but mass psychology. And mass psychology, the principles of mass psychology are different than the principles of individual psychology, by the way. So when we come to up-down cycles, we are looking at what's called right transition and left transition. And basically what that means is that, let's say that we're in an uptrend. So if we're in an uptrend, generally what's happening is price is making bigger moves to the upside and spending more time to the upside. Then when we get corrections against the uptrend, it's retracing a smaller degree of price and spending less time against the trend. So that's what we look for. Now this creates irregular cycles. Cycles are challenging, and I've seen some tools on charts where they just have these regular cycle indicators, okay, where you can make a cycle, you know, whatever, something like 18 to 20 bars is pretty typical. That's really not very useful in my opinion, because that may be an average, but boy, the duration of cycles varies dramatically. So we call that the expansion and contraction of cycles. We need something that's adaptable, more flexible, to truly measure cycles and be very helpful. But now, for an advanced trader, what you do is you look at that, you look at the up-down cycle, the sine wave type pattern, to catch, for example, I like to buy retraces in an uptrend. All right, so I like to buy wholesale, buy low, sell high. Then we combine that type of cycle with volatility cycles. This is why when I talked about the triangle example, I said I like to buy inside the triangle. If I think it's going to break out to the upside, I'm buying off of the bottom of the triangle trend line. So I'm combining those two cycles together. Then we can also combine those cycles with the order chaos cycle, meaning we're only going to want to trade during an orderly cycle when the market is making orderly patterns. And then we combine those cycles with calendar cycles. So here you look at whatever sector or market or industry you're trading or commodity that you're trading, and you say, okay, with regard to this sector, industry, commodity, whatever it is, what's the calendar cycle for this one? And it's very advanced trading to put all of that together and can provide incredible profits. Absolutely amazing. Here's an example, by the way, of up-down cycles. It's just, again, you see the little sine wave pattern here occurring as market. This is obviously in an uptrend, but it makes highs, lows, highs, lows, high, lows, basically higher highs and higher lows. And I've got a cycle indicator down there. That's just part of the cycle indicator that I use. Now, next Tuesday, I do have a free webinar on this. Again, there's no charge for that webinar. And what I'm going to do on that webinar is I'm going to actually give you, if you're interested, give you my cycle indicator, the timing indicator I use. So I'll give you that indicator for free. I don't have time. We've got like 5 minutes left here today. Oh, I do have 5 minutes before our next speaker. And so don't have time to go into this today, but next Tuesday we'll be giving away that indicator. And not only will I give you the indicator, but I will actually teach you how to use it, because giving you the indicator without teaching you how to use it is useless. So I'm going to actually teach you how to use it so that Wednesday morning or even Tuesday night, if you trade Forex, you'll be able to start using that indicator. And it is an amazingly accurate indicator. The win-loss on it is astronomical as far as nailing the final cycle low before the market goes up or nailing the final cycle high before the market goes down to avoid getting stopped out so often. And that's the key. That's where, again, my friend in Chicago was talking about retailers are often right but at the wrong time. get in at the right time. Buy the final low in the cycle before. I'm not talking about major highs and major lows here. I'm just talking about these cycle highs and cycle lows in the trend. But boy, that's key. You want to get that final retrace before the market goes back up and not suffer through ABC complex retraces and all that kind of stuff and get stopped out. And that's what this indicator will do for you. So my trading is all about waiting for the 5 energies to put the odds on your side. By the way, on Tuesday I'll go through those 5 energies as well. And these are the 5 energies if you want to write them down. Number 1 is trend. Number 2 is strength or momentum. So just because a market's moving up doesn't mean it will continue moving up after you get in. Momentum helps tell you if it's a strong trend or a weak trend. If it's a strong trend, then the third step is the cycle. I want to buy the final low before the market continues going up. I want it to bounce off support. That's my 4th energy. And my 5th energy is the energy of scale, which is the next higher time frame. But I do the higher time frames differently than is traditional. So again, I'll share that on Tuesday, how I do that. So in the meantime, we're just about out of time here. So I'll just tell you that my 5 energy method, I use it for stocks, commodities, options, currencies, and futures. And I trade them all because all I'm doing, I'm looking for opportunities. Wherever the opportunity is, that's where I'm going to trade. I do investing, swing trading, and day trading with the same methodology. It's very simple. You know, that's one thing I learned. Working with retail traders, I found they make things too complex. The professional traders, their methods are actually mostly pretty darn simple, and their advantage is their money management, their risk management, and their discipline. So I am offering today, I'm not selling anything today, but I'm offering today a free 5-day video correspondence course. So I'd love for you to get this. Enjoy every day for the next 5 days. You'll get a video, and at the end of the video, there's going to be some great lessons there. Mostly the lessons are about how traditional technical analysis is failing today in today's markets. What's working today? That's what we want to know, and that's what these videos are about. Interactive quizzes at the end of each one, so you can test yourself. On day 4, I'm going to give you one of my favorite setups, and you can actually start trading that setup right away. It comes with the rules and filters. My trading is very objective and rule-based. And you can get that by going to topdogtrading.com/free.html. And when you go there and you sign up for this course, then I will also send you information about Tuesday's webinar where you can get the cycle indicator. All right, so there we go. Wow. I covered a lot here today. Like I say, this was a basic overview of a lot of different things about cycles and timing. So Tuesday we'll get very specific, much more specific on it. But again, thank you guys here. I just appreciate you offering this this opportunity for me to come and speak and for everybody to get together here today. Thanks everybody for joining the webinar, and enjoy the rest of the sessions today.